Ever wonder why some people seem to effortlessly cruise through life with sky-high credit limits, rock-bottom interest rates, and financial doors that swing wide open, while others battle for years just to get approved for a basic credit card? What if I told you there's a hidden pattern that most people never discover, a simple code that completely transforms how your credit score behaves? Today, I'm going to reveal this exact system that banks quietly hope you never figure out. Here's the thing about credit scores that nobody wants to admit. The whole system isn't actually complicated. What makes it confusing is how it's presented to you. All those mysterious terms, conflicting advice, and numbers that seem to change for no reason. This confusion isn't an accident, it's profitable. When you don't understand how your score works, you make decisions based on fear instead of strategy. You pay unnecessary interest, avoid beneficial moves, and essentially hand money over to banks without realizing it. But once you understand the real mechanics behind credit scoring, everything shifts. You start getting approved for cards you thought were impossible, you qualify for interest rates that save you thousands, and it all starts with understanding the first piece of this credit code. Let me share something most people get completely wrong about credit card payments. Everyone talks about paying on time, but almost nobody explains the specific moment that actually matters for your score. Every month, your credit card generates a statement showing your balance, minimum payment, and due date. But here's what banks don't emphasize. The only number that truly matters for your credit score is that statement balance. And the only thing you need to do to avoid interest while building a perfect payment history is to pay that full statement balance by the due date. This single habit unlocks something powerful. First, you never pay a penny in interest because no balance carries over. Second, you nail the biggest factor in your score, payment history. This is 35% of your entire score, and it's the easiest factor to master once you know the rule. Your score responds to patterns. When you consistently pay that statement balance every single month, you're sending a clear signal to the credit bureaus that you're reliable, predictable. The system rewards this consistency far more than any other behavior. It's why one missed payment can haunt your report for 7 years. The system never forgets inconsistency, but it richly rewards patterns it can trust. And here's a small tip that can save you. If you accidentally miss a payment, you usually have about 30 days before it gets reported. Most lenders won't report it until it's a month overdue. So if you catch your mistake quickly, you can often fix it without any damage. Now let's talk about credit utilization, which makes up 30% of your score and is massively misunderstood. People think if they spend too much in a month, they automatically look irresponsible, but that's not how it works. The credit bureaus don't see everything you spend. They only see the balance that appears on your statement closing date. That single moment determines your utilization for the entire month. And here's the game-changing insight. Your score has no memory when it comes to utilization. If your utilization is high one month and low the next, the bureaus don't punish you for the previous month. They only react to what's reported right now. This is why your score might drop 20 points after a heavy spending month, then bounce right back when your utilization drops again. Once you understand this, you control your score. Let's say your card has a $5,000 limit and you make a large purchase that pushes your balance to $3,000. That's 60% utilization, which would temporarily hurt your score. But if you pay that balance down before your statement closing date, the bureaus might only see a $50 balance, giving you 1% utilization instead. This isn't cheating, this is understanding the timing that drives your score. Most people focus on the due date, but the closing date is what actually matters for utilization reporting. Let's address another crucial factor that affects 15% of your score, the length of your credit history. This isn't just how long you've had credit, it's the average age of all your accounts combined. This is where many people accidentally sabotage themselves. They close their first credit card because it doesn't have rewards. But closing your oldest card is one of the most damaging moves you can make. That first card carries years of history that strengthen your entire profile. Even if you never use it, keeping it open preserves the foundation of your credit history. Time is one factor you can't speed up, but you can protect it by never closing the accounts that anchor your history. Every time you open a new account, your average age drops slightly, causing a small temporary dip in your score. But the benefits of new credit almost always outweigh this. Understanding this means you don't fear opening accounts when it makes sense. You just space them out intelligently. Now let's dive into new credit and hard inquiries. When you apply for a card, the lender performs a hard inquiry that temporarily lowers your score by a few points. Most people panic, but hard inquiries fade within a year and disappear completely after 2. Meanwhile, the new credit line you gain provides more payment history opportunities, more available credit, and lower utilization. The key isn't avoiding inquiries, but using them strategically. So once you master these visible pieces, there's a deeper layer. When you consistently demonstrate responsible behavior, something shifts in how the entire financial system treats you. Banks don't just look at your score, they examine patterns. Every on-time payment is a signal. Every month with low utilization is a signal. Every aging account is a signal. When you stack enough positive signals, banks begin to trust you. This trust translates to higher credit limits, and this is incredibly powerful. Most people think they need to spend less to keep utilization low, but when your limits increase, your utilization automatically improves without you changing your spending at all. This creates a positive cycle where responsible behavior leads to higher limits, which leads to a better score, which leads to more opportunities. Here's the psychological shift. Banks raise your limits not because they like you, but because you've demonstrated predictable behavior. Predictable behavior is the true core of this entire system. It's like pushing a heavy wheel. The first turn is difficult, the second is easier, and then suddenly the wheel starts turning on its own. The code is consistency, not intensity. Understanding your statement closing date gives you incredible control. You could spend $2,000 in a month, but if you pay it down to $50 before the closing date, the bureaus only see $50. Protecting your oldest accounts is simple. Just make an occasional small purchase every few months to keep them active. The psychological impact of this is huge. When you have excellent credit, you become calm and confident when applying for financing. You no longer fear rejection because you know exactly how lenders see you. This confidence leads to better decisions. You choose products based on strategy, not desperation. And here's something that surprises many. The bureaus don't see your income or your wealth. They only see patterns of behavior with the credit you already have. This is why someone with a modest income can achieve an 800 credit score, while someone earning much more struggles. The system rewards patterns, not perfection. Lenders love stability above almost anything else. Steady payments, consistent utilization, predictable growth. All of this leads to the moment banks never want you to reach. When your score becomes strong and predictable, you gain leverage. You negotiate better rates, request higher limits, and qualify for premium products. You make financial decisions without fear. So here's how to remember the system. Pay your statement balance in full and on time. Keep utilization low by managing your statement closing date. Protect your oldest accounts. Space out new applications intelligently. Let your profile grow quietly and consistently. If you follow this approach, your credit score won't just rise, it will rise in a way that feels effortless and predictable. A high credit score isn't about perfection, it's about repeating simple actions over and over until the system cannot ignore your reliability. Once you unlock this, your score becomes a tool instead of a burden. You stop chasing approvals because approvals start chasing you. This is the system banks hope stays confusing, but now you can see it clearly. The score you want isn't far away. It's built one clear decision at a time, repeated long enough to become undeniable. There are hidden mechanisms that shape your world. The more you understand them, the better equipped you'll be to navigate them. That next insight could transform your entire future. Learn, save, grow.